These rules will help you not only to control your emotions, but also to act rationally, transforming potential pitfalls into opportunities for growth. Applying these principles can be a turning point in your trading journey, allowing you to achieve stable and long-term success. 1. Creating and adhering to a trading plan. Successful trading begins long before the first position is opened. It starts with the creation of a clear, detailed trading plan. This is not merely a list of rules, but a comprehensive roadmap that defines your strategy, entry and exit criteria, risk management, and even psychological guidelines. Having such a plan in written or electronic form is an absolute necessity, as it serves as an objective compass in the turbulent sea of market fluctuations. Without it, you are akin to a rudderless ship, drifting with the currents of emotions and arbitrary decisions, facing uncertain outcomes. Strict adherence to this plan is the most critical disciplinary requirement, as this is where a trader's true resilience is tested. When the market moves unpredictably, there is a temptation to deviate from the strategy, to slightly adjust a stop loss, or to enter a trade that does not meet your established criteria. These impulsive decisions, often fueled by fear of loss or greed, are the most common causes of significant setbacks and substantial losses. Your trading plan must be treated as a sacred document, safeguarding you from yourself, from those internal voices that push towards irrational and detrimental actions. It ensures consistency in your actions, allowing you over time to accurately analyze the effectiveness of your strategy. If you constantly deviate from the plan, you will never be able to precisely determine what works and what does not, leading to confusion and frustration. Thus, a trading plan is not just a decision-making tool, but also a foundation for continuous learning and improvement. It helps to separate objective analysis from subjective emotions, enabling you to act rationally even in the most stressful and volatile market conditions, fostering a calm and measured approach. 2. Effective risk management. Risk management is not merely one component of a trading plan, it is its very core, ensuring the long-term survival of your capital. Many traders make the fatal mistake of focusing exclusively on potential profits while ignoring potential losses, an oversight that can quickly lead to ruin. However, seasoned market participants understand that capital preservation is the number one priority, for without capital, trading is simply impossible. This mandates setting strict limits on the size of risk taken in each individual transaction, safeguarding your financial foundation. A widely accepted recommendation is to risk no more than 1 to 3% of your total trading capital on any single trade. This golden rule allows you to withstand a series of losing trades, which are an inevitable part of trading, without incurring catastrophic losses that could cripple your account. For example, if you have a $10,000 capital, a 1% risk means you are prepared to lose no more than $100 on a single trade. Such an approach significantly reduces emotional pressure, as you know that even in the event of failure, it will not lead to a substantial depletion of your account. The mandatory use of stop-loss orders is another fundamental element of effective risk management, acting as your crucial safety net. A stop-loss is a predetermined price level at which your position is automatically closed, limiting your potential losses before they become unmanageable. It serves as your insurance policy, protecting you from unforeseen market movements and your own emotional decisions that might otherwise lead to holding losing trades too long. Without a stop-loss, a small loss can quickly spiral into a monumental one if the market moves against you, and you cling to the hope of a rebound. Disciplined risk management is the guarantee that you will remain in the game regardless of how challenging or unpredictable the market may become. 3. Defining a favorable risk-reward ratio. Once you have mastered effective risk management, the next crucial step is to define a favorable risk-reward ratio. This is a key metric that allows you to assess the potential profitability of a trade relative to its potential loss. The fundamental principle dictates that the potential profit, take profit, should be at least twice as large as the potential loss, stop loss, providing a buffer for inevitable losing trades. An ideal ratio often begins at 1 to 2, but many successful traders consistently aim for 1 to 3 or even higher to maximize their long-term profitability. The rationale behind this rule is quite straightforward yet immensely powerful for ensuring sustained profitability over time. Even if you only win 50% of your trades, you will still be profitable if each winning trade brings in twice as much as each losing trade costs. For instance, if you risk $100 to gain $200 in profit, and out of 10 trades, 5 are profitable and 5 are losing, your net profit will be $100. 5 times $200, 5 times $100 equals $1,000. $500 equals $500. This mathematical advantage allows you to maintain a lower winning percentage while still remaining consistently profitable in the long run. This rule serves as a potent tool for cultivating both discipline and patience, as it compels you to be highly selective in your trading decisions. You will not rush into every seemingly attractive trade if it does not offer a sufficiently high risk-reward ratio that aligns with your strategy. This approach helps to prevent impulsive decisions and encourages you to focus only on those opportunities that possess a mathematically sound potential for profit, filtering out less favorable setups. By adhering to this principle, you not only protect your capital but also maximize your potential gains, ensuring a stable and consistent profitability over time. 4. Emotional control and psychological resilience. Perhaps the most challenging, yet simultaneously the most crucial aspect of successful trading is the mastery of one's own emotions. The market constantly provokes traders, eliciting a wide spectrum of feelings, from euphoria during profitable trades to panic during losses. Fear, greed, hope, and the urge to recoup losses are powerful forces that can completely cloud rational judgment and nullify even the most meticulously crafted trading plan. Market legends such as William Gann consistently emphasized the paramount importance of psychological preparation and mental fortitude. Fear can compel you to close a profitable trade prematurely, preventing you from capturing further gains, or to shy away from entering a trade that perfectly aligns with your established criteria. Greed, conversely, can tempt you to hold on to a losing position in the desperate hope of a turnaround, or to excessively increase your position size after a few successes, thereby significantly escalating your risk exposure. Hope often leads traders to ignore their stop-loss signals, clinging to the belief that the market is bound to reverse. And the urge to recoup losses after a setback is a direct path to even greater financial detriment, as it precipitates rash and impulsive actions that further compound the problem. Developing coolness under pressure and stress resilience is critically important for making objective and sound decisions. This means cultivating the ability to observe the market without emotional attachment to the outcome of each individual trade, viewing each transaction dispassionately. It is vital to understand that losses are an inherent and unavoidable part of trading, and they should be perceived as a cost of doing business, rather than a personal failure or a reflection of your inadequacy. Practices such as meditation, mindfulness, and maintaining a trading journal that includes emotional states can all significantly contribute to building robust psychological resilience. Remember, your greatest battle is not with the market itself, but with your own internal biases and emotional responses. 5. Developing patience and avoiding overtrading. In a world of high-speed trading and instant news, patience is often viewed as an archaic virtue. Yet in trading, it stands as one of the most invaluable qualities a trader can possess. Many beginners fall into the common trap of believing that the more trades they execute, the more money they will earn. However, the exact opposite often proves to be true, leading to diminished returns and increased frustration. An excessive number of trades, or overtrading, is a direct consequence of a lack of patience and an insatiable desire to be in the market at any cost, regardless of the quality of the setup. This often results in entering trades that do not meet your stringent criteria, unnecessarily increasing commissions and inherent risks. The importance of patiently waiting for clear signals and definitive confirmations before opening a position cannot be overstated. It is a cornerstone of disciplined trading. The market does not always present ideal opportunities, and a wise trader understands that sometimes the best action is indeed inaction, preserving capital for truly high-probability setups. Wait until your strategy provides an unambiguous, undeniable signal that aligns perfectly with your predefined conditions. This might entail hours or even days of patient waiting, but this fortitude ultimately pays dividends in the form of higher quality trades and reduced stress. Quality consistently triumphs over quantity, especially when it comes to safeguarding your hard-earned capital and ensuring long-term success. Overtrading frequently stems from boredom, an urgent desire for quick profits, or a desperate attempt to recoup losses after a setback. This creates a vicious cycle that depletes both your capital and your emotional resources, leading to burnout. To overcome this detrimental habit, focus diligently on adhering to your trading plan and, if appropriate for your strategy, establish strict limits on the number of trades you execute per day or week. Recall the wisdom of William Gann, who advised, "Do not trade unless you have a clear vision of what the market is going to do." Disciplined patience allows you to keep your powder dry for truly high-quality, high-probability opportunities, ensuring your capital is deployed strategically. 6. Overcoming the fear of missing out, FOMO. The fear of missing out, or FOMO, stands as one of the most insidious psychological adversaries a trader faces. It manifests when you observe the market making a swift and significant move in a particular direction, and you realize you failed to enter that trade, feeling left behind. The intense sensation that you missed out on a substantial profit can be unbearable, and frequently leads to ill-considered impulsive entries well after the primary move has already occurred. This is a classic trap into which many traders fall, buying at the peak or selling at the absolute bottom, long after the majority of the potential profit has been realized by more discerning participants. The mechanism of FOMO works by compelling you to deviate drastically from your carefully constructed trading plan and to blindly follow the crowd, which, as a general rule, is always late to the party. You witness others accumulating profits and feel an overwhelming pressure to join in, fearing that you will be left on the sidelines while opportunities pass you by. However, it is precisely during such moments that the market often prepares for a reversal or a significant correction, and those who succumb to FOMO become the liquidity for more experienced and patient players. This inevitably leads to rapid losses, which then further amplify emotional stress and reinforce the cycle of poor decision-making. Strategies for combating FOMO include strict adherence to your own meticulously developed trading plan, and a firm refusal to blindly follow news headlines or hot tips from unreliable sources. Your strategy must clearly define precise entry points, and if those specific criteria are not met, you simply do not enter the trade, regardless of how vigorously the market is moving. Remember that opportunities in the market arise continuously. There will always be another trade just around the corner. Instead of chasing a train that has already departed, it is far wiser to patiently await the next one that stops conveniently at your station. Discipline and patience are your most formidable allies in overcoming this prevalent and financially damaging psychological trap. 7. Maintaining a detailed trading journal. A trading journal is far more than a mere record of your transactions. It is your personal mentor, your impartial psychologist, and an indispensable tool for continuous self-improvement. Many traders unfortunately neglect this crucial rule, deeming it tedious or insignificant, yet it harbors immense potential for profound growth and development. The primary purpose of a trading journal is to meticulously record every single trade with all its pertinent details: the date, time, specific asset, entry and exit prices, position size, stop-loss level, take-profit target, and, critically, the precise reasons for both entering and exiting the trade. This comprehensive logging enables you to objectively analyze your results and identify recurring patterns in your trading behavior. However, the most invaluable component of a trading journal is the diligent recording of your emotional state during each trade. Make a conscious effort to document what you felt when you opened the position, when it was in profit, when it was showing a loss, and when you finally closed it. Were you calm and collected, or did you experience fear, greed, or irritation? This detailed emotional information is priceless for identifying psychological pitfalls and behavioral patterns that are detrimental to your trading performance. Perhaps you will notice a tendency to overtrade after a series of losses, or that you close profitable positions too prematurely due to an underlying fear of losing accumulated gains. The trading journal serves as a powerful instrument for self-analysis and profound introspection. By regularly reviewing your entries, you can clearly discern which strategies are yielding positive results and which are not. Pinpoint where you deviate from your meticulously crafted plan, and precisely identify which emotions are unduly influencing your critical decisions. This disciplined practice empowers you to learn effectively from your mistakes, rather than mindlessly repeating them over and over again. William Gann himself believed strongly in meticulous record-keeping and rigorous analysis, and the trading journal is the modern embodiment of this timeless principle. It transforms the trading process from a chaotic endeavor into a systematic and measurable one, forming the bedrock for discipline and continuous, incremental improvement. 8. Limiting the number of trading assets. In today's interconnected world, where access to thousands of trading instruments is merely a click away, there arises an irresistible temptation to attempt trading everything under the sun. However, this common pitfall often disperses your focus and severely hinders a deep understanding of any specific market. A disciplined trader understands that profound knowledge of a select few assets is immeasurably more valuable than a superficial monitoring of a multitude. The clear recommendation is to concentrate your efforts on a small, manageable number of instruments, for example, 1 to 2 currency pairs, a handful of stocks, or 1 or 2 commodities that you can truly master. The advantages of this focused approach are unequivocally clear and compelling. Firstly, you can dedicate your precious time and mental energy to thoroughly studying the intricate behavior of these specific assets. You will learn to instinctively understand their typical volatility, characteristic price movements, predictable reactions to news events, and their correlations with other related markets. This deep understanding enables you to develop far more precise and reliable trading strategies, meticulously tailored to these particular instruments. Secondly, limiting the number of assets significantly reduces information overload and the associated stress, allowing for clearer decision-making. You are liberated from the overwhelming task of simultaneously tracking countless charts and news feeds, enabling you to concentrate exclusively on truly vital and actionable information. Concentrating on a few chosen assets also significantly aids in avoiding the pitfall of overtrading, as you will not feel the incessant pressure to enter trades simply because something is happening in another unrelated market. You will be able to patiently await the ideal setups and perfect alignments for your selected instruments, which will inherently elevate the quality and probability of success of your trades. This rule emphatically underscores the critical importance of specialization and unwavering focus, which are fundamental keys to achieving mastery in any field, including the demanding world of trading. Indeed, less is often demonstrably more when it comes to effectively managing your trading portfolio and maintaining a stable, clear mental state. 9. Forming realistic expectations. One of the greatest impediments to achieving sustained success in trading is the prevalence of unrealistic expectations. Many novices enter the market harboring illusions of rapid wealth accumulation, seeing only the glamorous success stories and completely ignoring the stark reality that trading is a complex and demanding business that requires considerable time, persistent effort, and continuous learning. The fundamental realization that losses are an unavoidable and inherent part of trading, rather than a definitive sign of personal failure, is absolutely foundational for developing a healthy and resilient psychological approach. Even the most accomplished and successful traders experience losing trades. The critical difference lies in how they react to and process these inevitable setbacks. Avoiding excessive expectations regarding profitability is critically important for maintaining unwavering discipline. If you unrealistically expect to earn, for example, 100% per month, you will invariably be prone to taking excessive risks and making impulsive decisions when your actual results inevitably fail to meet these inflated targets. Realistic goals, such as consistently achieving a stable 5 to 10% return per month, are far more attainable and inherently foster a consistent, disciplined, and measured approach to the markets. It is crucial to internalize the understanding that trading is undeniably a marathon, not a frantic sprint, demanding endurance and strategic pacing. The paramount importance of adopting a long-term perspective and prioritizing stability over fleeting, short-term speculations cannot be overstated. True, enduring success in trading comes to those who meticulously focus on the consistent application of their well-defined strategy, prudent risk management, and relentless self-improvement. This entails gracefully accepting small losses as an integral and unavoidable part of the trading process and celebrating the consistent accumulation of small, yet stable profits. William Gann, much like other legendary masters of the market, profoundly understood that the market has zero tolerance for impatience and unbridled greed. Cultivating realistic expectations empowers you to remain calm, objective, and disciplined, even when the market presents its most formidable challenges, ensuring a steady hand at the helm. When we delve into the realms of discipline and patience in trading, it is simply impossible to overlook the profound legacy of William Gann. His seminal works, penned over a century ago, continue to resonate with remarkable relevance today, offering profound insights into the intrinsic nature of markets and the intricate psychology of speculation. One such foundational masterpiece is Truth of the Stock Tape, a true classic that meticulously explores market cycles, the nuanced behavior of prices, and perhaps most crucially, the inner psychological landscape of the trader. Gann, with astonishing perceptiveness, uncovers precisely how fear and greed exert their powerful influence on decision-making, and why cultivating unwavering self-control is paramount for achieving consistent and enduring success. This is not merely a book about technical analysis. It is a comprehensive manual on the psychology of trading, imparting timeless principles that transcend the boundaries of any specific trading strategy, offering universal wisdom. This extraordinary work serves as an invaluable resource for any serious trader who aspires to grasp the deeper, underlying mechanisms of the market and to understand their own intricate psyche more profoundly. It is instrumental in helping to forge a disciplined approach, which is the undeniable bedrock for any long-term success in the volatile world of finance. Through its pages, you will discover why it is absolutely essential to patiently await the precise right moments, how to meticulously analyze subtle market patterns, and how to deftly circumvent common pitfalls that are so often triggered by unchecked emotions. However, it is important to honestly acknowledge that the original historical charts presented within the book are unfortunately of very low quality and can be quite challenging for the modern eye to decipher. This specific limitation, while present, does not in any way diminish the profound value of Gann's core text, but it does necessitate that the reader focus primarily on his timeless wisdom and overarching principles, rather than attempting to meticulously interpret the visual examples. If you are genuinely ready to immerse yourself in a wellspring of knowledge that has profoundly shaped generations of traders and empowered them to cultivate an ironclad discipline, then Truth of the Stock Tape is an absolutely essential read. This remarkable book will equip you not just to trade, but to truly comprehend the market on an infinitely deeper level, which is the ultimate key to achieving genuine mastery. Do not miss this unparalleled opportunity to study these eternal principles, which remain as pertinent today as they were when first written. Navigate to the link provided in the video description to locate this iconic work by William Gann, and embark on your transformative journey towards more conscious, disciplined, and ultimately more successful trading. 10. Taking responsibility for your results. The final, yet by no means least important, golden rule of discipline and patience is the complete and unequivocal acceptance of responsibility for your trading outcomes. This entails the profound realization that success or failure in trading hinges exclusively on your own decisions, your actions, and your unwavering capacity for self-control. Regrettably, many traders, particularly after enduring a series of losses, tend to attribute their failures to external factors such as the market itself, their broker, breaking news events, the actions of whales, or even their astrological horoscope. Such an approach is profoundly detrimental, as it inherently prevents you from learning valuable lessons from your mistakes, and consequently, from growing as a trader. Avoiding the blame of external factors is a fundamental and indispensable step towards evolving as a proficient trader. When you choose to blame the market, you are effectively abdicating personal responsibility and simultaneously denying yourself the crucial opportunity to analytically assess precisely what you did incorrectly. This perpetuates a destructive cycle where you continue to repeat the same errors, simply because you failed to identify their root cause within your own actions and decision-making processes. In stark contrast, a disciplined trader, upon experiencing a losing trade, promptly turns to their meticulously maintained trading journal, thoroughly analyzes the situation, precisely identifies any weak points within their strategy or psychological approach, and then diligently develops a concrete plan for immediate rectification and improvement. The paramount importance of learning from your own mistakes cannot be overstated. Each error, when properly assimilated, transforms into an invaluable lesson that renders you stronger and significantly wiser. Accepting full responsibility means acknowledging that you exclusively control your own actions and reactions, not the unpredictable movements of the market itself. This empowering realization bestows upon you the intrinsic power to change and continually improve your craft. Legendary traders, such as William Gann, consistently emphasize the critical significance of self-discipline and profound personal accountability. This mindset enables you to cultivate a robust self-confidence that is firmly rooted not in fleeting luck, but in the consistent and deliberate application of proven, time-tested principles. Only then will you truly be able to transform the inevitable challenges of the market into stepping stones towards long-term, sustainable success. We have journeyed through 10 golden rules of discipline and patience, which are not merely recommendations, but fundamental pillars of successful trading. From the meticulous creation and strict adherence to a trading plan to the complete acceptance of responsibility for your own results. Each of these principles is an indispensable component of your path to mastery. The consistent application of these rules allows you to preserve your capital, which is the #1 priority, for without it, trading is simply impossible. They significantly reduce the emotional stress that is one of the primary causes of burnout and financial losses among traders, fostering a more sustainable approach. When you are disciplined, you act rationally, which inherently boosts your self-confidence in yourself and your critical decisions. This newfound confidence is not built on blind faith or wishful thinking, but rather on the consistent and demonstrable application of proven effective methods. Long-term success in trading is not a matter of pure luck or rapid enrichment. It is, first and foremost, a profound battle with oneself, a continuous dedication to self-control, and the relentless development of psychological resilience. This means that your greatest asset is not your trading account balance, but rather your disciplined mind and your unwavering capacity for self-mastery. Trading is a journey of personal growth that demands not only intellectual effort, but also considerable emotional maturity. These golden rules serve as your indispensable compass in this complex, yet immensely rewarding world. We urge you not simply to familiarize yourself with them, but to actively integrate and apply them in your daily trading practice. Allow these profound principles to utterly transform your entire trading approach, converting chaos into order and raw emotions into rational, strategic decisions. Your unwavering discipline today will undeniably pave the way for your enduring success tomorrow. The history of financial markets is replete with invaluable lessons that can serve as an endless source of wisdom for the contemporary trader. Gaining a profound understanding of how past events, significant financial crises, and the actions of eminent figures on Wall Street have profoundly impacted markets helps one to navigate the present landscape more effectively and even to anticipate future trends with greater clarity. If you are eager to deepen your comprehension of market cyclicality and the intricate psychology of the masses, we highly recommend exploring the Wall Street Memoirs channel. This unique resource immerses viewers in the captivating world of historical events that have meticulously shaped the financial landscape as we know it today. On this compelling channel, you will discover meticulously researched narratives about monumental crashes, epoch-making booms, and the fascinating stories of both financial geniuses and notorious fraudsters who have left an indelible mark on Wall Street. These are not merely dry historical facts. They are expertly curated and engagingly presented materials that will empower you to perceive the broader financial picture and to extract invaluable lessons from the collective experience of past generations. Studying these historical accounts serves as an excellent complement to the development of discipline and patience, as many of the events described are direct consequences of fundamental human emotions, namely, the potent forces of greed and fear. Do not miss this exceptional opportunity to significantly broaden your financial horizons and to enrich your understanding of the markets through a critical historical perspective. Wall Street Memoirs is far more than just a channel. It is a meticulously preserved archive of timeless wisdom, patiently awaiting your exploration. Subscribe to the Wall Street Memoirs channel via the link provided in the description to unlock profound lessons that have the potential to fundamentally transform your outlook on trading and long-term investing.